Thanks for tuning in for this month's Best Moments of the Futures Radio Show podcast. Futures Radio Show is sponsored by CME Group. They are the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com. For new show notifications, please subscribe to Futures Radio Show on iTunes, YouTube, Google Podcasts, Spotify, and Stitcher. And new in 2021, Futures Radio Show is now being recorded in video, exclusively on YouTube. This show is also sponsored by Trading Technologies, TradeStation, and FTSE Russell. The Russell 2000 is a key benchmark for small cap U.S. stocks. Be sure to check out the E-Mini Russell 2000 futures symbol RTY and Micro E-Mini Russell 2000 futures symbol M2K. To learn more about FTSE Russell and their products, please visit FTSERussell.com. Something every year you and we always talk about what's a theme for the next year. Not that we're changing much. We talked about that. What is something that you're doing next year to get better, like we discussed? And something I know you're doing this year is the Trade Right Initiative.
Yeah, so we're doing this. This is part of a convergence of focus this year. Last year was execution. You and I had talked about executing perfectly. What we found is that there's so much that goes into people who come into trading. It's very confusing to figure out what you're supposed to do. There's so many people shouting so many things. The Trade Right Initiative is our way of creating a path where if you take and do these certain steps, 11 steps, and then we follow it up with a 30-day challenge. So we want to show you what you need to have in place. You got to have some sort of a business plan. You got to have a risk plan. You got to write down what your trade plan is, your setups. How do you manage your trades, for example? You got to have a journal to track your performance. You got to set goals every Sunday for the following week, and then you got to track those goals and so on and so forth. So we want people to kind of follow a pattern to get those results, which is what we're here for. And then we attach to that a 30-day challenge to do what you're supposed to do for 30 days straight. And that's what the Trade Right Initiative is. It's common for people to kind of come along and do certain things and then switch. I'm going to trade the Crudele way. He's talking about this in the ultra bonds or this and that. And then I'm going to go listen to PAX and I'm going to listen to this guy and that guy.
Yeah.
And you end up by the end of the year, unfortunately, sadly, you end up with a bag of just stuff. You didn't really follow through on any of it. And this year it is to not worry about what Crudele is doing, not worry about what anybody else is doing. Just find your process and just follow that process for 30 days. It's kind of like doing a 30-day fast or something like.
No,
just
I like that.
Do it for 30 days. And the Trade Right Initiative is just going to continue to evolve throughout the year to keep traders working on the next thing. Our goal is to generate career professional traders. That's our objective. And so this is just one way to get everybody kind of following a path as opposed to just throwing information at them and hope they process it in the right order,
I love this because there is just so much information out there. And for you and I, it's easy to go to Twitter, read a couple of things, see how people are talking about long Bitcoin or whatever it is that they're trading. And it doesn't interfere with what I'm doing because you and I have been doing this forever. And for me, it just is one of those things where experience of going to doing those other things that people are doing and losing money, eventually you just say, I'm just going to do what I'm doing. I'm going to pick bits and pieces from what other people are doing, and maybe they could help me a little bit understand a macro theme or certain things going on, but still within my plan. I think so many new traders, they just get caught up in that one idea. They're looking more for that versus just, like you said, Trade Right Initiative. And What I really liked how you said is that, people do a 30-day fast, or at the beginning of every year, everyone's going to be dieting. I know my friends that own pizza places and stuff in Chicago, they're always like, January is brutal because everybody's on the diets. And then by February, they're back in those places. But start the year off on the right foot. Trade the way you want to trade. Then going back to everything we said this year, looking at your metrics, journaling, you actually have something to go off of now. You could see it for 30 days. And what are you doing after they've done this 30 days? Like you said, I think you mentioned there's an evaluation. Talk to us a little bit about what follows it.
Yeah, so once the 30-day challenge is done, there's a badge that they earn that tells us that, hey, they followed this path. And then our goal is the big piece here is accountability. Our goal is to match them up with other people who've done the 30-day challenge and create a support network, kind of like an AA sponsor type thing, to help people kind of weather through the grind that occurs between March through June-ish. And that would be the next step. Is we know you're committed. You've done the 30-day challenge. We know you're committed. So now it's worth the investment by someone else that you're matching up with to continue with the process to flow along. That's the goal. We want to make every trader like a prop trader. That's what we're after, is just get you to think of trading as a business. You're a performance athlete, who trades, and that's what we're after. And our goal is to just create the structure this year. Talking about execution alone, it kind of exists in a vacuum. With this, we're putting the whole kind of thing together.
No, I love it. Where can traders go to learn more about this, or how can they get involved with this Trade Right initiative?
You can always check out what we're doing at Convergent by going to convergenttrading.com. You can always tweet at me at twitter.com/futurestrader71. And I'm happy to answer your questions, or email support@convergenttrading.com, and we'll send you information.
Well, what's catching your eye lately? What are some things you're focusing on?
Well, I think that everybody should kind of be focusing right now on the central bank digital currency. I think I tweeted about it today. The ECB is definitely going to have a digital currency, which we all kind of knew that they were, right? The IMF started writing papers about it in like 2017. So you kind of knew that that's the direction that they were headed in. And then, you heard a lot of BOE brought it up, Carney brought it up, was the first person to bring it up, right? At Davos, I think, Mark Carney. And then the ECB started talking about it. And now we've heard a little bit about it from the Fed. So, that's something that you kind of know that is coming. And sort of, what concerns me a little bit about it is that, they're using it as a tool to basically ensure that they can instill heavily negative rates in times of recession. Which basically it punishes the savers. So, I have a lot of skepticalness about it in general, I would say. And if you don't really know a lot about it, I'll put out a tweet. There's a couple IMF papers that people should probably take a look at.
I don't know much about it. I've watched the things that you've tweeted about it. I've read very little on it, in all honesty. It's not something I've spent a ton of time on, but you're right. It's something that we have to keep an eye on right now. Why don't we just continue? Why don't you just maybe explain a little bit more to everybody about it? I think we all get the kind of gist of what it is, but right. Maybe not.
Yeah. So it's not exactly like, everybody says, well, everything's electronic payment as it is right now, right? But really what it is that it's giving the central banks control of not just monetary policy, but fiscal policy as well. And to me, that's a little bit dangerous, especially coming from an unelected body. And I think that's a lot of control to put within the central banks. So instead of, your electronic currency basically all goes through them instead of, a bank or whatever. So basically it's very centralized, and it gives fiscal policy power to the central banks.
And they've been punishing the savers for years. And thank you for explaining a little bit more. You and I on the trading side of things, what are the implications? What do you see as trades coming from this?
Well, I think, I think that it will, if we start seeing, deep negative rates, right? So I would start watching when, central bank rate policy, right? So that'll, affect bonds and whatnot. So that's kind of the trade that you want to be looking at. And then also, as they start implementing this, you will have to, look, are they going to completely phase out paper money? Are they not going to, or are they going to have a dual policy, right? ECB right now says that they'll still have paper money. But then again, that's going to affect the whole currency market in general. So, I would be looking at, treasuries and currency markets as we kind of switch over to these digital currencies.
Traders, we're going to pause for 15 seconds and we'll be right back. Trade the global markets with Trading Technologies. TT is the world's fastest commercially available futures trading platform, now with integrated tools for advanced options trading, cryptocurrencies, and trade surveillance. Learn more at tryttnow.com. Is you only figure out what type of trader you are, your style, can you get what you want out of the markets. And the reason I put that out is I was looking at everybody trying to, everybody is so focused on things that they can't control. As a trader, it's one of those things where it just drives me nuts because I only focus on things that I can control in my world. People feeling like they missed out on GME, that's just crazy to think about anyway, but all these other moves, Bitcoin. And instead of chasing those types of moves, there's probably only one trader that I truly know that actually searches out these volatile moves to take advantage of, and that's John Carter. He talked about that in the podcast. He's got a great, process for doing that. But if that's your process, that's fine. But I think that most people are trading just a handful of markets, especially futures traders. Stock traders, it's different. They trade as many markets as they want. They have certain criteria that they go through. But once again, go through that criteria. What type of trader are you? What style? And one of the comments that somebody put out, let me go back and read it. So LUMILOZ put out, meaning after finding product, time frame. And I said, yeah, product, time frame, technique, edge, strategy, building confidence in something, even if it's not working out right away. If you believe in it, then you'll get better at executing it. How many years have I been saying this on the show? You are better off believing in something that has a lower statistical probabilities than something that has high statistical probabilities that you have no idea what's behind it. I always talk about teaching traders how to think, not telling them what to think. I think a mistake that so many traders make out there right now is what to think. They want to know what to think. What should I buy? What should I sell? Don't think that way. If you want to learn from somebody, and there's a lot of people I've learned from on this show and beyond this show, and what I've learned from them is how they think, and that's how it's helped me as a trader, not by them telling me what to think. It just doesn't work that way. Know what type of trader you are first, then you could start taking advantage of situations. And I want to talk about Morgan Housel's tweet, this GameStop thing, as a reminder that investing is not the study of finance, it's the study of how people behave with money, and sometimes those behaviors are incredible. And I know I'm back to talking about GME, GameStop, whatever, but I retweeted that tweet. I don't retweet a ton of tweets, but that one I thought it's exactly right. That's perfect. And going back to, I look at it as, can I take a lesson from that? And the lesson is, as I talked about earlier, know where you're getting out before you're getting in. Hearing funds blowing up and these types of things happening, that's their business. That's what they do. But as a day trader, most of us, we're not trading other people's money. We're out there. we have to know where we're getting out before we're getting in. You should never be in a position to where you allow something like that to blow you out. And like I said, this is coming from someone who's blown out accounts, and it's not because I lost too much on one trade. It was because I had too many losers, and I can deal with that. But you've got to protect yourself, period. I mean, everybody talks about managing your risk. If you're blowing out for stuff like that, like I said, I'm not a stock guy. I don't know how they were positioned. I don't want to even, it's not what I want to talk about. The lesson for me is, once again, anything can happen. Protect yourself. That's all I can say. Another tweet, one of the most important things experience teaches you as a trader is that if you have time, you have time. Your self-awareness speeds up while time slows down in moments. To me, that's just so important. Your self-awareness speeds up as a trader with experience. What's happening right now? I know I have time. I don't have to make a decision right now. You don't need to be the first one in every single time. You don't need perfect entries. Everybody searches for perfect entries. I just want to know where I'm wrong. Let me figure out where I'll get in. If I think the trade has legs, I'll get in. You have time. It's just so important. And this awareness, this self-awareness, you only get from experience, period. Allow yourself time as a trader to gain this experience. That's what I put in the tweet. And it just is, it's just so important. I mean, everybody's in such a rush right now. The world is, I need this, I want this. It's like, well, it takes time. Don't rush it. You can't rush it. How about that?
I have 9 ES strategies. That's my bread and butter. I trade a number of things, but my bread and butter has been the ES over the years, the E-Mini S&P futures. I have 9 core strategies. I trade several variations of each, which in my mind are all discrete and independent. I know it sounds like a lot, but I'm just telling you what it takes to make it in the markets. You got to be diversified. Diversification is your friend just as a day trader, just as much as it is for a long-term buy and hold investor.
Before we get into rapid fire, could you just give us the checklist, let's call it, of things, if you're a trader out there listening to this show and saying, you know what, I want to start quantifying my trades, I want to quantify my edges. What are a checklist of things that they should go through to quantify that?
Yeah, so first, before you even quantify anything, is the setup that have some logic to it? Some causation. I call it my 3 C's. I think I've talked to you about this before.
Yes,
causation, right? Is there some logic, some cause that gives me reason to trust the numbers if they're good, if they turn out good? If it doesn't pass that, I'm not in there. Second thing I'm looking for is context, as I mentioned. And the third one I haven't talked about today is confirmation. I want to be able to prove, once I've created that final strategy with stops and targets, I want to be able to confirm that similar setup on a sister market if I'm trading the indices. So if I have a strategy built or an edge that I find that I think meets my criteria, I want to see it also work fairly well on the YM or the NASDAQ. The Russell is a little bit different. I don't spend as much time on that one, but it has to work on a sister market or I'm not going to trust it. It hasn't confirmed the edge. I may have over optimized or curve fit something. You can over optimize by having too many factors. I don't optimize stops and targets really as much as I look at lots of different factors. So those are my 3 C's: causation, context, confirmation. If I don't have a sister market, let's say you're trading gold or oil, then a very helpful technique is have a sister time frame. So I like to enter around the open, but if I enter at the open and I'm holding a position for a fairly sizable move, which I try to do these days, and I'm going to be in it for hours, that edge should show up if I'm testing, say, a 15-minute range breakout, right? Or even a 30-minute range breakout should have some confirmation of my opening strategy. And if not, then I really, you got to back up and say, maybe I'm pushing too hard. I'm trying too hard to find an edge when there isn't one. And once in a while, there are things that I just totally understand that it works on the S&P and it doesn't work on other things. But I had to monitor it for a while before I came to trust some of those things. And they're few and far between.
How did you develop that style and develop your edge in trading energy?
Yeah, I started my career on a physical desk. And in that way, physical logistics are all about relative value between two things because you're trying to essentially arb out locational spreads or quality spreads or time spreads. So in that way, I never look at a market on a singular basis. I look at all of the relationships. And over time, I found that there aren't a lot of tools out there, except for maybe at the very high end, if you want to talk about Bloomberg or something like that, but that allow me to pull in and look at markets that way. So I started making them on my own. First in Excel, and then I just taught myself some Python, right? Now I just code them all. And people are always asking me, hey, Brynne, what service are you using? And I'm using, my 10 fingers. So, I like to know all of the pieces of the puzzle. And I am very disciplined about every single day pulling all of the data. I want to see it. I want to see the shifts in structure of the market, see the shifts in spreads between things. For me, those are indicators, you may say. I know how market players that physically can take advantage of differences will act. And I know what the market will look like if they act in that way. So, I'm not about big data, but I am about all the data, just pulling all the pieces. I think about if I was trading S&P futures, I wouldn't want to just see the futures contract because I'm not a technical trader. I'd want to also see all the components that make it up. And that's what these benchmark energy futures are. WTI crude oil, it's really the clearing index for all of the other locations. Natural gas, right? It's the clearing for all of the other locations in a sense. And in that way, I like to see where the opportunity is because it's not always at the benchmark. A lot of times the opportunity is in one of the other grades or locations.
What's interesting to me with all the energy traders that I talked to over the years, and most recently on this show, like even with Eric Townsend, very few of the energy traders that I know trade outrights. It seems like pretty much almost all of them focus on the spreads, or they look at other things. They're not just focusing on the front month contract in natural gas or the front month contract in crude oil. But there's so many new traders that come into trading and they look at crude oil and they look at natural gas, and that's primarily what they focus. But yet you are a pro. Many of the other traders that I talk to are professionals and have been at this at a long time. Why is it that part of your edge is not just trading the front month contract and focusing on it and maybe in the technical aspect, like you mentioned, you're not a technical trader. Why is it so important to look at spreads and just other things besides just that front month and technicals?
Well, you're very perceptive. You've picked up a lot. I know that my edge is not technical trading. And, for so many reasons. I don't have co-located servers, right? I don't have a proprietary chart. Just me being another person looking at a chart that everybody looks at. I'm not bringing anything to the table on that. And when you get into the fundamental realm, where, especially after years and years of seeing the market, you realize that the outright price is irrelevant in a lot of ways.
Interesting.
Obviously, we saw a big swing this year, right? And there are, kind of headline maker prices, but the relationship between either the calendar structure or the spread between being able to move something, either within the US or overseas, the spreads are showing you the marginal unit. And that's what energy is. The price that's trading is, the last molecule, right? It's the last molecule that's clearing, and that's kind of setting the price. And in that way, you can establish timing for expressing something, natural gas has been a great example this year where people have an expectation of a condition that is going to exist in the future in natural gas based on beliefs about production. And yet there isn't a tightness condition right now in the US. And so you can't really get the market to move. And in that way, I don't care what the price is, that will tell me where I finally move because the condition exists. I care about maybe how a spread might react, regardless of where prices go.
I'm so glad that we're getting a chance to talk today, because I was actually thinking about the podcast that you and I did last year. And, you know, with every guest that I have, I really try to walk away with one thing that I take away from each of the podcasts. And something that you had said in the podcast resonated with me for really the rest of the year. And I think, I mean, it's just one of those things that'll continue to resonate with me. And it was the way you put it, it was so simple. And it was something that I think a lot of us think about. But the way that you put it was something to me, and even though I don't trade stocks, I trade futures, it actually really helped me a lot last year. And what you said was, and correct me if I'm wrong, I'm going back to remember this, was you said, if you ever want to outperform the market, you have to buy the things that are outperforming the market.
Yep.
Right? And
yeah,
for me, I'm a futures trader, and I like to buy the strong. I like to trade the indices. So I trade NASDAQ, S&P, Russell, and I always like to buy the strongest. I think that so many traders like to fade the strongest or to buy the weaker to like kind of look for that balance. And I just kept thinking about something that when you had said that, it was like, you know what? That's such a simple mindset to have, and what all of the stock guys are doing. And that's why the leaders continue to push higher. So I know I started off with that today because we talked a lot about your strategy. You know, you're a market technician. Mm-hmm. But we didn't talk too much about your edge. And I was thinking, I'm like, I wonder if that actually is, if that plays into what your edge is.
Absolutely. I mean, that is truly how we implement our portfolio weightings and positions for clients. We want to be in things that are outperforming, whether it's an index, a sector, a sub-industry like transportation, or an individual stock. We want to be in things that are outperforming. I don't really have time to sit around and hope that a stock turns around or make an assumption that you know, a stock's putting in a bottom. So I'd add on top of that is the consistency of, you know, buying the exact same types of setups. I get a lot of questions on Twitter about, you know, people will say, oh, Ian, you post the exact same type of setup. Is this all you do? And yeah, it is. I'd much rather be, you know, pretty good or as good as I can be at one thing, rather than trying to be a guy who buys breakouts or a guy who trades ranges, a guy who, you know, is looking for to buy, you know, a MACD cross, looking to catch the bottom somewhere. I'm not looking to do all those things. I want to own areas of the market and individual stocks that are leading the indices higher, right? And an index is really just an average of a bunch of things in, you know, simplistic terms. And so you're going to have some things that are doing better than the index. You're going to have things that are doing worse than the index. Together, averaged together, they make the index. But we want to be in that top tier, the things that are leading higher.
So I'm going to quote my good friend Tom Canfield and Larry Tenerelli, be dumb, follow price. They're always putting posts out about that. I feel that very similar. And to me, I feel that that's very similar to what you're saying. You're just saying, look, if these are the leaders, follow them. Why are you trying to fade them? Is that what you're saying?
Absolutely. I mean, and take things like the Russell. I mean, this extended run of outperformance on the Russell. How many times could we, as guys who look at charts, pointed to this thing and looked at like, wow, this is stretched, or wow, this has gone too, you know, quote, one of my favorites, people say too far, too fast.
Yeah.
I mean, we've seen plenty of examples over the last 12 months where that's really just not the case. Momentum can really carry you. And it's the same, right, on an absolute basis, but also outperformers typically keep outperforming.
Yeah, absolutely. I mean, things that are overbought can tend to stay more overbought. I mean, it's just, so I guess I want to get into a little bit of the details on this because, as I mentioned from our friends that say, be dumb, follow price. But I know that for you, you have a specific way that you go about deciding, okay, this has happened and now this is the one we're going to be in. Because outperforming, it's not just a day or I don't know the exact, well, I'll have you explain the time frame that represents the outperformance. Talk to everybody about how you actually execute that edge by buying them. What triggers it?
All right, so I'd say that the process really starts with scans. So we're consistently looking for stocks that are making new highs. That's great. They also need to be making new relative highs. And it's actually, you can use a lot of technical analysis, a lot of type of the same breakout and support and resistance mentality on relative charts as well. So that really starts with the scans. And then again, we want to see broad participation. So if we're running an intraday scan of stocks making new highs, and for example, recently they've been jam-packed with semiconductors and banks. And so we know that there's also kind of breadth under the surface that those types of stocks as a whole are leading the market higher. And that also, seeing that, maybe we'll go ahead and we'll also add a broader position in semiconductors like SMA, like an ETF SMH or something like that. So that's kind of a double way to play it. Now that doesn't always happen just because there's only so much cash in portfolio. I wish I could own everything, especially in these environments where micro caps and small caps are outperforming. But that's really how it's cut. And there may be a stock that looks great and it's in an uptrend and we bought it because it was showing good relative strength. But while maybe no sell rules were broken on an absolute basis, that can happen on a relative basis. So just because something has been in an uptrend since we bought it, that doesn't mean it can't get cut while still in that uptrend if we need to jump to something else that's just a little bit better. Now, are these decisions, we're not scalping, we're not, trying to be in these for 2-3 days at a time. We are looking to be in these, ideally multiple weeks and even, some positions multiple months, as long as they behave and are showing relative strength. Obviously getting a good cushion off the bat helps a lot, as it does with any type of trading. So a good couple first weeks of outperformance in a trade will give me a lot more confidence to maybe hold that through a week or two of underperformance. If I think that broader thesis is still there for that name and for the peer group.
This year, actually, I'm pretty stacked up with a lot of people that use Market Profile coming on the show. I get a ton of requests for people to say, Anthony, bring on more people to talk about Profile because it's become such a popular tool that traders use. And,
yeah, great.
And I've had really, to me, no offense to you or anybody who uses Profile, but I had Dalton on the show, and to me, he's the one who really, I read his books, talked with him extensively about it. He's
the godfather.
The godfather. That's a great way to put it. So what was interesting is that when he was on the show, he said to me, he's like, you know what? The profile isn't my edge. It's just a tool I use, but it's not my edge. What about you as someone who uses the profile? What's your edge?
Yeah, I would agree that the profile itself is not an edge. Just like if you talk to Morad, it's not like, I'm not a profile trader. All we use the profile to do is to help us organize information in the auction.
Bingo.
and make some decisions around that. Now I take it to kind of a different level of informing my edge, in that I've spent a fair bit of time extracting what I call behavioral statistics that you can pull off of the profile.
Okay.
And the different day types, so there's nomenclature for people who are like really into auction theory. There's nomenclature of day types and open types, and you can actually extract statistical normalized behavior off of those things to give you an edge. And it's not like with any market statistic, it's not a full fail-proof metric, but it's something to go, hey, do I have reasonable expectations about what's going to happen now, given what's happened so far, and can that help me inform my decisions?
Explain that in a little bit more detail. Give us an example of a statistic that you pull from the profile that helps give you an edge.
Yeah, so the one that I always, we get traders that come to us often who have been in the industry for some time, love the market, and are still feeling like, man, like there's something missing, and I'm trying to get my arm around that. And so the first thing that we do is we look at what we call the initial balance. So that's the range of the first hour of the day. And what's interesting is that and it doesn't matter what product at all, any equity product, any of the futures asset classes, but if you look at the first full hour of that product, and you go back, like say 1,000 trading sessions, so go 5 years of data, is that 97% of the time we're going to get outside of that first hour's range. That's a meaningful statistic. And then once I get outside of that range, I find that once I've exceeded it to one side, there's only about a 30% chance I'll exceed the other side of that range. And then, so that then reduces the probability of one side being extreme. So that gives me a risk measurement. And then on top of that, once I've exceeded it, what's the percent probability that I'll exceed that range measured against itself, say 50% or 100%? And I find, like if I take the S&P, for example, so the S&P, 68% of the time, once it's exceeded the initial balance to one side, it's like today, it only took out the IB high, it's only going to see the IB high. Well, then the probability that it'll go another 50% of that original initial balance is about 60% of all trading sessions. And then to go to, to double that range, it's about 25%. And so you can use that and say, okay, so where am I within that range to give me an idea of what's the normalized statistical probability of continuation, that then I can lay on top of, okay, well, what kind of day am I looking at? Because if it's a trend day, that'll be one of those days that I'll exceed those expectations. If I've got some rotations, then I can say, hey, this might be a good place that I could fade this. I've reached some of these expected ranges, and now I've seen some rotation, so I know that there's some fight. Here's the place to play from the edges.
So if something happens like that you talked about with the initial balance, you go and look at statistics, and then because if the probability is greater that something will happen, you consider that one of your edge. So you go to the statistics. I totally understand that. Talk to us about, do you have multiple setups? Is it one setup that you're trading? Discuss a little bit more on how you developed, I guess, your overall edge.
Yeah. Multiple setups. I've developed a playbook over the years and expand it, and then also have contracted it as I found that there's more setups that I like trading better than others. Yeah, we kind of all do that.
Yeah,
it happens. Anybody who's been in the industry long, and that's actually been one of the great things about having a community of traders that I'm always developing, because they're always like, where is the next edge? And they're always pushing me to try to find that. So that keeps me evolving and looking at different stuff. But the first place that I start is I do look at that initial balance every day, because the probability that it's exceeded, I can ask two simple questions of like, do I go with that or do I fade it? And it's just a really simple, framework. And then I can cascade from outside of that. So I can say, well, if I'm going to fade that, so what's the order flow look like so far? How much of the expected range within the, that we saw out of the options market has been covered? Have we done 80% of that range? Have we done 70% of that range? Have we done, like the NASDAQ has done 150% of that? So like those are inputs that all cascade out. Almost think of it like a flight plan. If you've ever been done any pilot training, there's so much stuff before you ever get off the ground, but it kind of starts with, here's an idea of where I want to go. And I really every day I keep pointing people back toward use that initial opening hour. Like if you're not consistent yet, like a great way that you can be consistent in process is wait for that hour to complete, see how the auction's behaving within that hour, what those ranges were, and then go from there to build out.
Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a review on iTunes. You can listen to all of our episodes on futuresradioshow.com, iTunes, YouTube, Google Podcasts, Spotify, and Stitcher.